Greetings and welcome back to Connecting Smoke. I'm the founder, Razul Wallace, and today I'm going to continue to talk about the expenses associated with the property. Last video, I broke down all the expenses to consider when looking at a property, but I wanted to make a separate video specifically for just the mortgage portion of it because it contains different aspects and there's some nuance. So I just wanted to take the time to make sure that I explained it clearly and concisely. In the mortgage, there can be as many as 5 different items, depending on the lender and the mortgage company. Including in those items is the principal and interest portion of the payment, property taxes, property insurance, private mortgage insurance, and HOA dues. And what I use as a tool to help me figure this out is this app called Mortgage Calculator Plus. It's very simple, very easy to use. But if you don't want to download an app, you can just go on to you can just Google Mortgage Calculator and a number of free options will generate. This is a free option also, but it has ads, but you can pay to have the ads removed. But let's get into what goes into a mortgage. This is the app that I use to calculate mortgages. It's Mortgage Calculator Plus. And it has all the elements that you will need for whatever mortgage you're using. You can choose to use those items or not, but for a mortgage, the principal and interest is always gonna be there, whether you're borrowing from a bank. You have some creative finance options and you're using seller financing, whatever the case is, principal and interest is gonna be the one common aspect of a mortgage that you will always pay. And the reason I say that is because if you do some sort of seller or creative financing, the mortgage that you pay to them might only be principal and interest. When you go to a bank, they'll usually want to escrow for these other items, property taxes, insurance, HOA dues, and PMI. So in most instances, when you're going to a financial institution, all of these will be included. So some of the expenses from the operating expense portion will be covered in the mortgage. But I want to make it clear that that is not always the case, and that for seller or creative financing, you might have to go and pay your property taxes separately, pay your homeowner's insurance separately, or your HOA dues separately. For this illustration, I'm going to go back to the same property that I've been talking about. This 4-family in my town that we purchased for $235,000. We put $35,000 down. So in this, you can put a percentage or a flat dollar amount. And the seller actually gave us a good rate. We gave him his terms, or his purchase price that he wanted. And so he gave us our terms and gave us a really good rate at 4%. And the mortgage on this property comes out to $94 and change. So $94 is just the mortgage portion, the principal and interest mortgage portion of this property. It's amortized over 30 years with a 5-year balloon, which means that the payments are broken up as if it's a 30-year mortgage, but the 5-year balloon means that we have to figure out how to pay that full amount, the full balance owed at the 5-year mark. Whether we refinance and go to a bank and get a loan to pay it off, or we sell the property, either way, we just have to pay the entire balance at the 5-year mark. For this property, I could also include, if I wanted to get like what the mortgage would look like if it was a bank mortgage, but everything was included. I could do that by just entering the property taxes, which for this property are $75.82 a year. The annual homeowner's insurance is $23.40. No HOA, no PMI. So you'd be looking at a mortgage of about $1,781 for this property if you were to include those other items. But in the previous video, they were included in the operating expenses. So for the case of this, I can just use the $954, I believe 83 cents is the monthly payment for this mortgage. Just the principal and interest portion only, because I've already included the property taxes and homeowner insurance when I did my operating expenses. So whenever you're doing your mortgage, you just got to know who the money or the note is being held by and what they're including in their mortgage. Again, if it's a bank, they're going to include all of these things: principal, interest, taxes, insurance, HOA dues if there's a homeowners association, and PMI. For PMI, it can vary widely, but in this, I'll generally just put 0.5% or 0.5%. And that seems to be a reasonable placeholder. In this case, it added $83 a month based on the mortgage amount. And that's the range of where mine has been in the past. But I know recently I saw with a 5% conventional mortgage, the PMI tends to be much higher. But for FHA and some of the other traditional loan products that I've used, you know, that 0.5% will get you a good ballpark figure that'll have you right about where the banks will have your PMI. I hope this was clear and easy to understand. I knew I jumped around quite a bit, but when you're calculating your expenses, you're gonna have your operating expenses, which we talked about in the last video, and then the principal and interest portion of it is considered your debt service. And a lot of why that is separated from regular operating expenses is because a portion of it is going to be principal. The reason that I believe the debt service is generally separated from operating expenses is because the debt service has to be split up into the principal and interest portion of the payment. Interest is going to be tax deductible. Principal is not going to be tax deductible because that is going to building the equity in your property. So you're kind of getting that back. You're not paying that out. That's just going to be going essentially to the equity of the property. That's the main reason that I believe that it's not included in the operating expenses, because it kind of has to be separated and it has to be clarified what is going to what. I hope that this made everything clear, but your gross income minus your operating expenses minus the debt service payment equals your monthly cash flow. Once you get that monthly cash flow figure, I then divide it, or I divide the total upfront investment by that number to give you your annual cash on cash return on investment. I hope this was clear. I'm going to reiterate to make sure it is clear that your gross monthly income, or better yet, do it annually, because to get the cash on cash ROI, it's always viewed from an annual perspective. So your gross monthly income times 12 minus all of your annual operating expenses, minus your annual debt service payments. That will give you your cash on cash, your cash flow, and your annual cash flow divided by your upfront investment is what gives you your cash on cash return. And that's one of the biggest metrics that I use to measure or to evaluate if a property is going to be a good investment. So I hope this was clear. And this is the video about mortgages. And I'll be back to continue the breakdown with the next video in the series, which will be putting it all together. Thanks again for watching, and remember to rein yourself in.